The market has been on the tear lately. The S&P 500 has reached another all-time high, and suddenly everyone's a genius investor again. With that kind of momentum, it's no surprise that the word bubble is starting to make its rounds, and analysts are now warning that valuations are now trash. But here's the thing, even in a hot market, not every stock has been performing well. There are still strong companies that are left behind, as they are weighed down by short-term fears or temporary headwinds. And that is where opportunities often hide. In this video, I'll walk you through 5 companies that I believe are still undervalued, and why I think the market may be mispricing them. These aren't just speculative plays, these are established businesses with durable advantages, strong cash flow, and clear catalysts ahead. So without further ado, let's jump to the first company on this list, Amazon. While most of the Magnificent 7 stocks have been on the run this year, Amazon has been lagging behind. In fact, year to date, Amazon has barely given any returns, and if we zoom out to the 5-year horizon, the stock has returned just slightly over 33%, significantly underperforming the S&P 500, which has delivered close to 100% over the same period. Now, there are a few reasons for this underperformance, but 2 stand out in particular: cloud growth slowing down and weak free cash flow growth. First, let's talk about cloud. AWS has always been Amazon's crown jewel. It is a high-margin engine that powers the rest of the business. But over the past few years, that pace has cooled. Growth slowed from 39% in 2021 to just 18% in the most recent quarter. Not just that, this slowdown is happening at a time when Google Cloud and Microsoft Azure are expanding at over 30% annually. So, not only is AWS growth slowing, but its competitors are gaining ground. This has led investors to question whether AWS best days are behind it, and whether Amazon can maintain its leadership in the next wave of cloud computing. The second issue is free cash flow. One of the biggest criticisms of Amazon has always been about its capital allocation strategy. Unlike Apple or Microsoft, which have consistently returned capital through dividends and share buybacks, Amazon has historically reinvested nearly every dollar back into the business. It has poured tens of billions of dollars into expanding logistic networks, building data centers, and funding ambitious pushes into industries like streaming, healthcare, and AI. And while this long-term reinvestment strategy has helped Amazon build powerful moats, this has often resulted in little or sometimes even negative free cash flow growth. However, here's why I believe Amazon is still a really strong business with plenty of room to grow from here. First, on the cloud front, the recent slowdown in AWS isn't actually because of weak demand, but rather it is due to capacity constraints, especially power. Amazon CEO Andy Jassy has also noted that supply should eventually catch up over the next few quarters, and once that happens, AWS growth should pick up again. For instance, Morgan Stanley expects AWS revenue growth to climb back toward the low 20% range by 2026 as new capacity comes online and AI workloads scale. And this demand story is backed by real numbers. In the latest quarter, Amazon reported that it had about $195 billion in remaining performance obligations, with an average duration of 4 years. That is a massive backlog that gives AWS strong revenue visibility going forward. On top of that, as the Anthropic Trainium clusters go live, AWS should also be able to meet demand more effectively and continue its growth. Second, outside of cloud, Amazon's profit mix is getting healthier. In Q2 2025, advertising revenue grew about 23% year-on-year, and subscription revenue was up around 12%. Both of these segments are high-margin, asset-light businesses that scale well and have plenty of runway left. Advertising is increasingly being woven into Prime Video, Amazon Fresh, and Alexa, which gives Amazon more surfaces to monetize without heavy reinvestment. At the same time, subscription revenue is supported by a sticky Prime membership base of over 200 million users globally, which not only provides stable recurring income streams, but also strengthens customer loyalty. But perhaps the bigger story here is robots. Even though Amazon isn't usually seen as a robotics company, with over 1 million robots, it actually operates the largest robotic fleets in the world. And they've also recently introduced Deep Fleet, a generative AI model that coordinates these bots. It's already improving robot travel efficiency by roughly 10%, which may sound small, but at Amazon's scale, that is enormous. Because even with a 10% efficiency gain, that will translate into faster delivery times, lower energy usage, and huge cost savings, all of which will directly strengthen Amazon's logistics moat and profitability. And it's not just inside warehouses. Amazon's self-driving unit, Zoox, has also started offering free public robotaxi rides in Las Vegas while awaiting regulatory approval to charge fares. This is a clear sign that autonomy is going to be a bigger part of Amazon's logistics strategy in the future. Finally, there's free cash flow. Amazon free cash flow can look a bit messy because of its aggressive investment cycles, sometimes even going negative. But Amazon has shown that when their spending slows down, its cash flow can rebound very quickly, flipping from negative to strongly positive in just a few quarters. That kind of explosive turnaround is exactly what happened in previous cycles, and we are starting to see early signs of it again now. From a valuation standpoint, Amazon is currently trading at roughly 33 times as compared to the historical average of 34 times. If we assume Amazon to have a 22% growth rate, the company would not have much upside. But given that the company has grown its earnings per share by an average of 27% over the past 5 years, if Amazon is able to achieve a slightly higher growth rate, say 25%, this would mean the company is currently undervalued by around 19%. In short, even though Amazon stock has lagged the broader market recently, many of the fundamentals have actually been strengthening. This is a company that's been building for years, and now it is set out for a rebound. Quick pause, most of the data that I shared earlier actually came from Moomoo. It's actually one of the easiest ways to access a wide range of information. And the best part, Moomoo's AI can automatically analyze all this data for you. All you have to do is open the stock that you are interested in, tap on the Moomoo AI button at the top right, and type in the question. For example, you can ask Moomoo to help you analyze whether a stock is currently expensive or not, and Moomoo will do that for you. Moomoo can also help you analyze your holdings, and it will provide you with a comprehensive analysis of your positions while helping you identify potential opportunities and risks. Besides that, if you scroll down on the stock page, you can also see the daily and weekly briefs summarized by Moomoo. This will allow you to quickly understand the recent stock price trends and major news events of the company, all of which can help you make better investing decisions. New users who sign up to Moomoo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes a $60 worth of Nvidia share. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Next up, we have Adobe. And this is another stock that hasn't been doing so well recently. Over the past 5 years, Adobe has fallen by around 30%. This is despite a clear growth in its business fundamentals, where its revenue, net income, and free cash flow has been going up. So, what's going on? A big part of Adobe's weakness boils down to fears of rising competition, especially in the age of AI. Adobe was once seen as untouchable in the creative software world, where it dominates the industry with tools like Photoshop, Illustrator, and Premiere Pro. But over the past couple of years, there's been a flood of new AI competitors appearing, like Midjourney, Canva, Figma, Nano Banana, and most recently, Sora 2. These platforms have made content creation faster, cheaper, and in some cases easier to use than Adobe's professional suite. Essentially, Adobe's moat is being challenged on all fronts, and investors are worried that these tools could eat away at Adobe's dominance. Take Canva for example. Canva reported reaching 175 million monthly active users in 2024, up from just 60 million in 2021. It's hard to think that some of those users didn't come from Photoshop. To add on, AI hasn't yet delivered the immediate revenue boost that many investors were initially hoping for. So, back in 2023, when Adobe launched Firefly, its generative AI model, its adoption has actually been very strong. And by 2025, users have generated over 8 billion images using Firefly's tools like Generative Fill in Photoshop and Text to Vector in Illustrator. However, while usage has skyrocketed, its monetization has lagged behind. Most of these features were initially bundled into existing subscriptions for free, so they didn't immediately translate into higher revenue. But personally, as an Adobe user myself, I find it hard to imagine most Adobe users, whether it's professionals, freelancers, or even small teams, switching away. For many of us, Adobe tools are deeply embedded into our workflows. So even as my Adobe bill seems to creep up every year, I can't easily switch, because to do that, I will have to relearn entirely new softwares, and more importantly, find and retrain a whole new editing team. That's time-consuming, disruptive, and honestly, a headache. This is perhaps Adobe's real moat: deep integration, inertia, and network effects. While casual creators might jump ship to Canva or AI tools, professionals and agencies who make up Adobe's most profitable user base are much stickier. Looking ahead, Adobe has a few catalysts at play. First, it has started monetizing Firefly more aggressively by introducing credit-based usage and premium subscription tiers that include AI capabilities. The hope is that over time, this should raise average revenue per user as heavy users pay more. Second, Adobe is launching Gen Studio, a new end-to-end platform that combines content creation, management, and AI-driven personalization for enterprise marketing teams. This is a massive market, and if Gen Studio gains traction, it could unlock a whole new revenue stream. And third, Adobe valuation has come down quite a bit. Currently, its stock is trading at 21 PE, compared to its 5-year average of around 42 times. Meanwhile, based on GuruFocus intrinsic value calculator, if we assume a 20% growth, it would mean Adobe is currently undervalued by 45%. Now, of course, Adobe's success isn't guaranteed, and the threat is real. If you prefer simpler companies with way less business risk, Adobe may not be the best pick, as it still has to navigate through real competition through an evolving AI landscape. On the other hand, if you believe Adobe can successfully monetize its AI tools, defend its professional mode, all while tapping into new enterprise opportunities like Gen Studio, then the current pullback might actually be a rare chance to pick up a high-quality software leader at a reasonable valuation. Next up, we have ASML. Prior to its most recent run-up, ASML was actually down by 40% from its peak. And even after its most recent run-up, ASML PE is still below its 5-year average. So what's causing the disconnect here? One of the biggest reasons is the shift in market expectations following ASML's latest earnings guidance. So even though the company reported solid second quarter results, management warned that it cannot guarantee growth in 2026, which of course scared away some investors who had priced in perfect growth. Besides that, geopolitical headwinds have also played a major role. ASML has been caught in the middle of escalating export restrictions. Both the US and Dutch governments have tightened controls on the sale of ASML's most advanced lithography machines to China, one of its key markets. These restrictions came into effect more aggressively in late 2024, and ASML itself acknowledged that export curbs have dampened Chinese consumer spending and will continue to affect its sales outlook in 2025. On top of that, there's been added uncertainty from global trade tensions and tariff risks. The US has floated new tariffs on advanced technology equipment, and while ASML's machines are essential, any disruption in trade flows or component supply chains can create headaches for the company. Lastly, a part of ASML's stock volatility simply comes down to timing and the nature of its business. Each of ASML's machines can cost more than $350 million, and they are often delivered in small numbers to a concentrated set of customers. This means its order book can be lumpy, and quarterly results can swing sharply depending on when customers choose to place or delay orders. However, despite all these short-term headwinds, the long-term story for ASML remains very compelling, because in the end, this is still the company that makes the most critical machines for producing the world's most advanced chips. And while short-term demand has softened, the semiconductor industry is already laying the groundwork for the next capex upcycle. Global chip demand is expected to continue heading into 2026 and beyond, led by explosive growth in AI infrastructure build-outs, data center expansion, and the next generation of high-performance chips. Analysts also expect TSMC to continue increasing their capital expenditures to meet AI demand, while Intel and Samsung are pushing forward with their next-gen nodes. These aren't just nice-to-have purchases, they are essentials. And if chip makers want to keep improving their performance, they will need ASML's machines. Looking ahead, ASML is entering a major new product cycle with its high-NA EUV systems, which represents the next leap forward in chip making technology. These systems allow chip makers to print even finer features, enabling more powerful and efficient chips. Shipments have already begun, and ASML has plans to ship around 5 to 6 high-NA systems annually by 2026, before scaling up further to meet higher demand. From a valuation perspective, ASML is currently trading at around 36 earnings, slightly below its 5-year average. Though, if you use an 18% earnings per share growth rate, the stock may be trading close to its fair value now. Moving on, we have Novo Nordisk, the Danish pharmaceutical giant behind blockbuster weight loss and diabetes drugs. For most of the past few years, Novo Nordisk has been one of the market's standout winners. Its share price surged by almost 300% as demand for its GLP-1 based weight loss drugs exploded worldwide. At its peak in late 2024, Novo even briefly became Europe's most valuable listed company. This is an incredible feat for a pharmaceutical company, but after peaking in late 2024, shares have slipped by almost 60%. So, what's behind this pullback? The biggest reason is simply because expectations have become too extreme. By late 2024, Novo Nordisk was trading at well over 40 times forward earnings. It was a valuation that priced in years of uninterrupted growth and flawless execution. When a stock is priced for perfection, even the smallest hiccup can lead to a big correction. And that slowdown eventually came. In 2024, the company's growth started to normalize, and when supply ramp-ups turned out slower than expected, sentiment shifted quickly and the stock began to slide. Another major factor has been rising competition, especially from its US rival, Eli Lilly. Lilly's GLP-1 based diabetes and weight loss treatments have been scaling rapidly, particularly in the US, where the company has managed to ramp up production more consistently. This supply advantage has allowed Lilly to capture momentum in a market where demand is booming. Analysts now expect Lilly's US market share to catch up to Novo Nordisk within the next 1 to 2 years. This intensifying rivalry has made investors more cautious about Novo's ability to maintain its dominant position indefinitely. And to add on, all of this is happening at a time when Novo Nordisk has been struggling to keep up with demand. The company has repeatedly warned that supply constraints for semaglutide will continue into 2025, especially in the US, where demand has exploded far beyond manufacturing capacity. To address this, Novo is building new manufacturing facilities and expanding existing ones in Denmark and the US. But these are multi-year projects, and the benefits won't be fully felt overnight. In the meantime, supply remains tight, and that has limited the company's ability to fully capitalize on the demand surge. However, despite these challenges, Novo Nordisk's core business remains extremely strong. Demand for GLP-1 drugs is still booming, with long waiting lists in both the US and Europe, and the company has only launched these treatments in a limited number of countries so far, with many large markets, including much of Asia, remaining untapped. Financially, Novo Nordisk is in an excellent shape. In 2024, the company reported 37% revenue growth and maintained operating margins above 40%, which is among the highest in the global pharmaceutical industry. GLP-1 drugs already make up more than half of its total revenue, and they are still in the early stages of the global rollout. Looking forward, Novo is also working on next-generation oral GLP-1 treatments, which could make the therapy more convenient and expand its reach to patients who prefer pills over injections. Additionally, there's also growing evidence which suggests that GLP-1 drugs don't just help with weight loss and diabetes, but also improve cardiovascular and kidney health, which could support broader insurance coverage and long-term use. Looking at valuations, the recent pullback has brought Novo Nordisk to more reasonable levels. The stock is currently trading at around 15 PE, in contrast with its 5-year average PE of 33. And in terms of intrinsic value, even if we just use a 13% earnings per share growth rate, the stock still remains relatively cheap, with a 30% upside. In short, Novo Nordisk's stock fell because of valuations overheating, competition ramping up, and the supply couldn't keep up with demand. But the underlying business still remains incredibly strong. For long-term investors who believe in the structural shift toward GLP-1 therapies, Novo Nordisk remains one of the most dominant and profitable players in global healthcare. Lastly, we have United Health. So even after the stock went up by 50% after Berkshire Hathaway announced their purchase, the stock is still down by 40% from its peak. The biggest reason for this decline was due to a sharp rise in medical care utilization and costs since mid-2023. That drove up claims expenses for insurers like United Health. And by 2024, medical loss ratios, aka the percentage of premium revenue spent on patient care, has climbed more than analysts had expected. This led to margin pressures and a series of earnings downgrades, which caught many investors off guard. At the same time, regulatory scrutiny has also increased, particularly around Medicare Advantage, which is United Health's most profitable business segment. US regulators have introduced tougher reimbursement rules and risk adjustment changes, which effectively reduce payments to insurers. This has created additional uncertainty around future profitability in a segment that has historically been a major earnings driver. Additionally, several large insurers, including United Health, have come under Department of Justice investigation over billing practices, specifically in how they report patient risk scores to increase reimbursements. While no verdict has been reached yet, the investigations have added another layer of headline risk. But despite these headwinds, United Health remains one of the most dominant players in US healthcare. It covers over 50 million members, operates one of the most sophisticated data analytic networks in the industry. On top of that, United Health also owns Optum, a services and pharmacy benefits management business that contributes to more than half of its profits. More importantly, the company has already adjusted its pricing for 2025 plans, incorporating higher medical costs into premiums, which should help stabilize margins. Analysts expect earnings growth to re-accelerate into 2026 once the temporary cost spikes and regulatory adjustments are fully absorbed. The stock's pullback has also brought its valuation down to levels not seen in years. United Health now trades at around 15 times price to earnings compared to its historical average of about 25, despite maintaining industry-leading margins and a very strong competitive position. And if you assume a 13% earnings per share growth rate, United Health is still currently undervalued by around 27%. For a company for this scale, stability and cash flow generation, this could represent an opportunity to pick up a high-quality healthcare leader while sentiment is still cautious. And there you have it, 5 companies that, despite facing their own unique challenges, still have strong fundamentals, clear growth drivers, and valuations that are probably more attractive today than they were 1 or 2 years ago. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.